Have you ever stared at a single candle on your chart and felt like your entire future depended on what it would do next? If you have, you're not alone. Every trader, new or experienced, has felt their heartbeat rise as they watch a candle form, hoping it goes their way, fearing it won't. That tiny bar of price action seems so simple, yet it has the power to trigger greed, fear, overconfidence, hesitation, and even self-doubt. Here's the truth. The market isn't really moving you, you're moving yourself. The next candle doesn't care about your hopes, your account balance, or your dreams of financial freedom. But your psychology? That's what shapes how you see the market, how you react, and ultimately, whether you win or lose. This video isn't about predicting charts or giving you another secret strategy. It's about mastering the one thing you actually control, your mind. Inside, you'll discover how to break free from emotional traps, reset after losses, think in probabilities, and trade without the mental baggage that ruins so many accounts. Because in trading, the most important skill isn't predicting the next candle, it's controlling how you respond to it.
Chapter 1. The candle isn't the market, it's you. Have you ever looked at a single candle forming on your chart and felt your chest tighten? 1 second it's green, your heart races with excitement. The next, it flips red, and suddenly it feels like your future, your money, even your worth as a trader is slipping away. That tiny bar of price action feels like a verdict on who you are and whether you deserve to win in the markets. But here's the raw truth. That candle doesn't care about you. It's not out to save you, hurt you, or test your discipline. It's just data. Price moving because millions of buyers and sellers around the world are making decisions for reasons that have nothing to do with you. Yet your brain treats it like it's personal. That's where the real battle begins. When traders first enter the markets, they believe the fight is against the charts. They think success comes from finding the perfect indicator, the best entry, or the magic formula to catch every move. But after 20 years in this game, I can tell you this. The fight isn't against the chart. It's against your own psychology. Let me tell you a story. Back in my early days, I remember placing a trade on Euro-USD. It was a textbook setup, the kind you dream about when you're studying price action. I entered, set my stop loss, and watched the candle start moving in my favor. For the first 3 minutes, I felt like a genius. I was already calculating how much I'd make if I let it run. But then, without warning, the candle started to pull back. In seconds, all my confidence turned into panic. I didn't want to lose the little profit I had, so I closed the trade. 30 seconds later, the market shot up in the exact direction I had predicted. My perfect setup had been correct, but my psychology destroyed me. What happened? I wasn't reacting to the market, I was reacting to myself. That candle wasn't telling me to panic. My fear of losing made me see it that way. This is what I call emotional mirroring, when we project our feelings onto the chart. A green candle feels like validation. A red candle feels like rejection. We treat candles like they're messages from the market about our worth as traders. But the truth is, they're not mirrors of the market. They're mirrors of us. Think about it. Why do two traders look at the exact same candle and feel completely different emotions? One sees opportunity, the other sees danger. One feels excitement, the other feels dread. The candle hasn't changed, it's neutral. The difference is the story each trader attaches to it. And that's the lesson most beginners miss. Trading is less about what the market is doing and more about what you think the market is doing. This might sound abstract, so let's make it real. Imagine you're at a casino watching a roulette wheel spin. If you've just lost 3 bets in a row, your brain will scream at you. Don't bet again, you'll just lose. But if you've just won 3 times in a row, the same brain will whisper, go big, you're on a hot streak. The wheel hasn't changed. The probabilities are the same. What's changed is your psychology. And now replace the roulette wheel with the trading chart. That's exactly what's happening every time you watch the next candle form. The market is neutral, but your brain makes it emotional. The science backs this up. Behavioral economists have shown that humans feel the pain of losing twice as strongly as the pleasure of winning. This is called loss aversion. In trading terms, it means a tiny red candle can hurt you more than a giant green candle can please you. That's why so many traders cut winners too early and let losers run too long. It's not a strategy issue, it's psychology. And here's where it gets dangerous. When you start seeing candles as personal, you start breaking your own rules. You close trades too early, you move stops, you double down out of frustration. You stop following your plan and start following your emotions. And the worst part? You'll justify it to yourself. In the moment, you'll say, I'll just move my stop this one time, or this candle looks different, or I know my system says wait, but I can't miss this. Sound familiar? It should. Every trader has done it. And if you're honest, you've probably done it this week. So how do you break out of this trap? The first step is awareness. You need to recognize when you're trading the candle versus when you're trading your emotions. That's harder than it sounds, because emotions disguise themselves as logic. Fear says, close now before you lose it all. Greed says, hold longer, you can squeeze more in. Both sound like reasonable thoughts in the moment, but they're not logic, they're impulses. Here's a practical exercise that saved my career. The next time you're about to make a trading decision, pause and ask yourself this question. If I weren't in this trade already, would I still take it right now? That single question strips away emotional attachment and forces you to see the chart for what it is, not what you wish it was. Most of the time, you'll realize your decision is being driven by fear or hope, not by your plan. Another trick is journaling. Not just your trades, but your feelings during those trades. Write down what you felt when the candle turned red, or how your thoughts shifted when it flipped green. Over time, you'll start noticing patterns. You'll see that the same emotions keep coming up, no matter what the chart looks like. And that's when the light bulb clicks. The battle isn't with the chart, it's with you. Think of it like looking in a mirror. When you see yourself tired, stressed, or anxious, you don't blame the mirror, you fix what's wrong. The chart works the same way. It reflects your state of mind. If you're calm and disciplined, the candle looks like data. If you're fearful or greedy, the candle looks like life or death. The mirror doesn't change, you do. Let me give you one more story. Years ago, I mentored a young trader named Mark. He was sharp, disciplined, and had a solid strategy, but he couldn't stop blowing accounts. When I asked him to show me his trades, I noticed something. His entries were fine, but the moment a candle went even slightly against him, he panicked and closed his trade. When it went in his favor, he held too long, waiting for a miracle top. I asked him to record himself on video while trading, and what we saw was eye-opening. The second a candle moved against him, his breathing changed, his shoulders tensed, and he leaned closer to the screen. He wasn't trading the chart, he was trading his stress. The fix wasn't a new strategy, it was awareness. Once he saw how his emotions were driving him, we built rituals. Deep breathing before trades, a 2-minute timer before closing any position, and a strict rule to never watch a candle form tick by tick. Within 6 months, Mark turned profitable, not because his strategy changed, but because he changed. That's the journey every trader must take. If you're reading this, you probably don't need another indicator or a secret signal. What you need is to see the chart for what it really is, a reflection of your psychology. The next candle is neutral. The meaning you give it comes from you. Here's the bottom line. Trading isn't about controlling the market. It's about controlling yourself. The candle isn't the market. The candle is you. Once you master that truth, you stop fighting battles you can't win and start focusing on the one you can win, mastering your mind. Because at the end of the day, the next candle doesn't decide your success. You do.
Chapter 2. Fear of missing out versus fear of losing. Have you ever felt that sudden urge to click buy or sell just because the market seemed to be moving without you? Maybe a green candle shot up and your heart said, "Get in now or you'll miss it." Or perhaps a red candle dropped and you thought, "I need to exit before it gets worse." If you've experienced this, congratulations. You've met two of the most powerful forces in trading: fear of missing out, or FOMO, and loss aversion, the fear of losing. These emotions are sneaky. They don't announce themselves as irrational impulses. They disguise themselves as logic. FOMO whispers, "You're going to regret not acting." Loss aversion warns, "If you hold, you'll lose more than you can handle." To the inexperienced trader, these feelings feel real, pressing, and unavoidable. Yet they're not dictated by the market. They're dictated by your own brain. I remember a young trader named Alex, who started his first live account with $5,000. He was methodical, had studied charts for months, and even created a trading plan. But one morning, he saw Bitcoin spike 10% in an hour. Every trader in his chat room was celebrating. Alex felt his chest tighten. He didn't even analyze the setup. He just bought in, hoping the trend would continue. Within 15 minutes, the price pulled back sharply. Panic consumed him, and he sold at a loss. His plan had been perfect, but his fear of missing out destroyed it. FOMO is like that. It's a social and psychological pressure that convinces you the opportunity you see is the only chance you'll ever have. It doesn't matter how well you planned, how much research you did, or how your strategy works in theory. The moment your brain convinces you that missing this move is catastrophic, you act impulsively. FOMO is often strongest when the market is volatile, and the higher the potential gain, the stronger it grips you. On the other side of the coin is loss aversion. While FOMO pushes you to act impulsively, loss aversion freezes you. Loss aversion is the psychological tendency to feel the pain of losing more intensely than the pleasure of gaining. In trading, this means that a $100 loss feels far worse than a $100 gain feels good. Many traders fall victim to this, closing positions too early to avoid loss, or refusing to enter trades at all because they are afraid of being wrong. I once mentored a trader named Sarah who struggled with this. She had developed a simple system to trade Euro-USD with clear entry and exit rules. But every time a trade went against her by even a few pips, she would panic and exit. She was technically correct in every analysis, but the psychological pressure of seeing a red candle made her make the wrong choice. Over months, she realized that she was not losing because her strategy was bad, but because her fear was stronger than her discipline. So why do these two forces, FOMO and loss aversion, dominate so many traders' decisions? It's simple. Our brains are wired for survival, not trading. Thousands of years ago, our ancestors had to react quickly to danger. The brain rewarded risk-taking in opportunities for food and punished hesitation when survival was on the line. Similarly, it made losses feel sharper than gains, because avoiding a loss could mean life or death. Trading exploits these very instincts, but the stakes today are financial rather than physical. Unfortunately, our ancient wiring hasn't caught up to modern markets. Here's an example everyone can relate to outside trading. Imagine you're at a Black Friday sale. A brand new gadget is on sale for half its price, but only a few remain. You feel the pull to grab it immediately, afraid that if you hesitate, it will vanish. That's FOMO. Later, you buy it and realize it wasn't even the gadget you truly wanted. You felt the pressure, and it led you to a hasty decision. On the flip side, imagine you see a great deal, but you hesitate because you're afraid of wasting your money. That's loss aversion. You miss the opportunity entirely, even though it was objectively a good deal.
Now replace that gadget with a stock, forex pair, or crypto trade, and you see how these same emotions play out in trading. So what can you do to overcome FOMO and loss aversion in your trading life? First, awareness is key. Recognize when you're feeling an emotional pull. Ask yourself, am I acting because of a trade setup or because I'm afraid of missing out or losing? That pause, even a few seconds, can prevent impulsive actions. Second, develop concrete rules and stick to them. Professional traders don't leave trades to emotion. They plan entries, exits, and stop-loss levels before they even touch the market. By having a structured plan, your brain has a roadmap to follow, which reduces the power of irrational impulses. When FOMO whispers, you can respond, "I will wait for my setup, and if it occurs, I'll act according to the plan." Another powerful tool is journaling. Not just writing down trades, but noting how you felt during each trade. Did FOMO push you in? Did fear of losing make you exit too early? Over time, patterns emerge, and you start recognizing triggers and can work proactively to manage them. I've seen traders transform entirely once they understand the emotional stories they tell themselves during each candle movement. Mindset exercises also help. One simple technique is imagining that the market is infinite. There will always be another trade, another candle, another opportunity. When FOMO strikes, remind yourself, missing this one trade is not the end. There will always be another. This mindset reduces the urgency that FOMO tries to instill. Equally important is detaching from your ego. Many traders feel that losing a trade is a personal failure. But the reality is, the market doesn't judge you. A red candle is not a verdict on your intelligence or worth. Accepting this truth allows you to see losses as normal and reduces the fear that make you exit too early. Losses are tuition, not punishment. Let's talk about patience. One of the biggest weapons against both FOMO and loss aversion is patience. Waiting for the right setup, sitting on your hands when nothing is aligned, and resisting the urge to act impulsively can feel painful at first. But every trader who has mastered this realizes that patience multiplies profits and prevents unnecessary losses. Think of it like fishing. You could cast your line anywhere, hoping for a bite. Or you could study the water, wait for the right moment, and catch a big fish. FOMO wants you to cast wildly. Patience teaches you to wait for the right moment. Finally, creating routines outside the charts is essential. Emotional trading often comes from external stress. If you've had a bad night's sleep, a fight at home, or a stressful day at work, FOMO and loss aversion will hit harder. Simple routines, deep breathing, short walks, or even meditation can stabilize your mind and improve trading decisions. I want you to imagine this. Picture yourself 6 months from now. You're sitting in front of the screen, the market starts moving fast, and you feel that familiar surge of anxiety. But this time, something is different. You pause. You recognize the emotion. You breathe. You consult your trading plan. You let the market form and you follow your rules. The candles keep moving, but your mind is calm. You've tamed the most powerful forces in trading, FOMO and loss aversion. And because you've done that, your profits start to reflect not luck, but discipline. That's the secret. Traders fail not because they can't read charts or indicators. They fail because they surrender control to two powerful, ancient instincts. By recognizing them, naming them, and building systems to manage them, you gain an edge no one can take away. FOMO will whisper, loss aversion will warn, but you, the disciplined trader, respond rationally. You trade the setup, not the emotion. You see opportunity, not threat. You see the candle as data, not destiny. Because in the end, every green candle isn't a golden ticket, and every red candle isn't the end of the world. They're simply probabilities moving as the market dictates. The edge comes from the mind that controls how you respond to them. Once you master your fear of missing out and fear of losing, you are free to trade with clarity, confidence, and calm. And that is when trading stops being a roller coaster and starts being a craft that you can learn, master, and profit from consistently.
Chapter 3: The Illusion of Control. Have you ever found yourself staring at a chart, convinced that you know where the next candle will go? Maybe the patterns look perfect, the indicators align, and everything seems logical. You feel confident, almost invincible. And then the candle does the exact opposite. You're left questioning your skill, your strategy, even your judgment. If this has happened to you, welcome to a truth every trader eventually faces: the illusion of control. Most new traders enter the market with the belief that success is about prediction. They study charts, watch indicators, read news, and develop strategies, all with the hope of forecasting the next move. It's understandable. Human brains are wired to predict. We want certainty, especially when money is on the line. But markets are not deterministic. They are probabilistic. Every candle, every price movement is influenced by countless factors, many of which are completely invisible to you. Yet your mind fights against this reality. It creates the comforting illusion that you can control or predict outcomes. I remember a trader named Jason who swore he had a gift. He could read candles like an open book, he claimed. His friends and fellow traders watched in awe as he would enter trades confidently, narrating exactly what he thought the market would do next. And for a while, it seemed true. He caught a few wins, reinforcing his belief. But the market is not a loyal friend. It is neutral. Eventually, one day, the market shattered his confidence. Every position went against him, and he lost a month's profits in a single afternoon. He wasn't trading anymore. He was gambling under the illusion of control. The problem is deeper than just overconfidence. It is rooted in cognitive biases that trick us into thinking we have more influence than we actually do. One such bias is pattern recognition. Humans are natural pattern seekers. We look at a few green candles and convince ourselves this trend will continue. We see a head and shoulders formation and feel certain that a reversal is coming. Sometimes these patterns work, and when they do, our brains reward us with a hit of dopamine, reinforcing the belief that we are skilled predictors. Another bias is confirmation bias. Traders tend to notice signals that confirm their beliefs and ignore signals that contradict them. If you believe a currency pair will rise, you'll see evidence that supports your view and dismiss data that says otherwise. This creates a false sense of control. You feel like the market listens to your analysis when in reality it operates independently. Then there's the illusion of skill versus luck. Early wins, especially in a volatile market, often result from luck rather than skill. Traders mistake these lucky streaks as mastery, which strengthens the illusion of control. They increase position sizes, ignore risk management, and start treating trading like a certainty instead of a probability game. The market eventually humbles them, but the damage can be financial and psychological. I want you to imagine this in everyday life. Think about driving to work. Some days you take the same route and everything goes smoothly. You might start thinking, I know exactly how the traffic will move today. I can control my commute. And then, out of nowhere, there's an accident, construction, or sudden rain, and your plan falls apart. You weren't in control. You were simply managing probabilities. Trading works the same way. You can increase your odds, but certainty is a myth. Understanding probabilities is the first step in overcoming this illusion. Every trade has a chance of winning and losing, The goal is not to predict the future perfectly, it is to align yourself with high-probability scenarios, manage risk, and accept that losses are inevitable. I've seen traders transform when they switch from a prediction mindset to a probability mindset. Suddenly, losses feel normal, wins feel rewarding, and emotions stop controlling decisions. Storytelling helps make this concrete. Sarah, one of my mentees, used to enter trades believing she could feel the market. If a candle turned green in the first 5 minutes, she would go all in, convinced she knew the outcome. Inevitably, she lost more often than she won, and the losses devastated her confidence. Together, we worked on reframing her mindset. Instead of trying to predict every candle, she focused on setups with statistical edges, predetermined stop losses, and clear risk-to-reward ratios. The transformation was remarkable. She stopped chasing the illusion of control and started trading with clarity and discipline. Let's talk about the psychology behind this. The illusion of control taps into our desire for certainty. Uncertainty is uncomfortable, especially when money is on the line. Our brains crave a feeling of mastery, even if it doesn't exist. This is why we exaggerate the role of our skill when we get lucky, why we obsess over perfect setups, and why we react emotionally when the market behaves unpredictably. It's a normal human reaction, but it's deadly for traders. There's a simple but powerful exercise I teach all traders. Before entering a trade, write down the probability of success, the risk, and the potential reward. Be brutally honest with yourself. If you believe a trade has a 60% chance of success, remind yourself that 40% of the time it will fail. Accepting this before placing the trade removes the illusion that you are controlling the market. It's a mental anchor that keeps emotions in check. Another technique is scenario planning. Before entering, ask yourself, what if this trade goes against me? How will I respond? This isn't pessimism, it's preparation. When the market inevitably does something unexpected, you already have a plan. You're reacting to probabilities, not to fear or hope. Traders who failed to do this get caught in reactive behavior, which is often costly. Risk management also directly combats the illusion of control. If you trade as if you can predict every candle, you might take oversized positions. If you use proper position sizing, stop losses, and risk limits, even when the market goes against you, your account survives. This survival allows you to trade another day, learn, and refine your approach. It's the ultimate reality check against overestimating control. Now, let's bring this into everyday analogy. Imagine you're cooking a new recipe. You follow the instructions perfectly, but the outcome depends on variables like the oven's exact temperature, the quality of ingredients, and even the altitude. You can't control it all. You can, however, follow steps that increase your chances of success, measuring accurately, monitoring cooking time, tasting as you go. Trading is the same. You can't predict exactly where the next candle will close, but you can take steps to increase your probability of a favorable outcome. Let me give you one more real-life trading example. Michael, a day trader, would watch a stock fluctuate and try to sense where it would go next. He spent hours analyzing charts, reading news, and tracking market sentiment. When he guessed correctly, he felt like a genius. When he was wrong, he blamed the stock, the broker, or the news. After months of inconsistent results, he finally realized the problem. He was chasing an illusion. The market wasn't responding to him, he was responding emotionally to every tick. When he shifted to a probability-based approach, his results became consistent. He stopped chasing the illusion of control and started controlling what he could: position size, risk, and discipline. The key takeaway here is that trading success comes from understanding that uncertainty is inevitable. No one can predict the next candle perfectly, no matter how many indicators, systems, or tips you use. The market doesn't care about your opinion, your luck, or your skills. It moves based on collective actions that you cannot control. Your edge comes from discipline, risk management, and emotional control.
By embracing this truth, traders free themselves from unnecessary stress and impulsive decisions. They stop trying to force outcomes and start working with probabilities. They learn that losses are not failures. They are part of the statistical nature of trading. They stop equating their worth with individual trades and begin seeing the bigger picture. A series of well-managed decisions over time leads to consistent results. When you finally internalize this, you begin to enjoy the market rather than fear it. You trade setups, not impulses. You respect risk, not punish yourself for losses. You approach every candle with curiosity, not obsession. The illusion of control fades, replaced by clarity, confidence, and a mindset tuned for long-term success. Trading is not about predicting the next candle. It's about mastering your response to uncertainty. The market is a mirror, reflecting the choices you make under uncertainty. The moment you stop chasing control and start embracing probability, the market becomes less intimidating and far more rewarding. In the end, the biggest enemy of a trader is not the market. It is the belief that we can control what cannot be controlled. By letting go of this illusion, we reclaim our power, the power to trade rationally, to follow a plan, and to turn uncertainty into opportunity.
Chapter 4. Waiting is a position too. Have you ever felt the urge to click buy or sell just because the market was moving, even when nothing in your plan aligned? Maybe you've stared at a chart, saw a few candles form, and thought, I need to get in now, or I'll miss this move. If this feels familiar, you've experienced the struggle between impulse and patience, the silent battle that separates consistent traders from those who chase losses. In trading, one of the hardest lessons to learn is that doing nothing is often the most profitable action. At first, this seems counterintuitive. After all, we enter the markets because we want to make money, and making money requires taking positions, right? But the truth is that every trade you don't take is a trade you didn't lose. Every candle you skip while waiting for a high-probability setup is a small victory in discipline, a step toward consistent success. I remember my early days vividly. I was sitting in front of my screen, watching EUR/USD form a pattern that looked promising. I was itching to enter, convinced I saw the next big move. My heart raced, my hands hovered over the keyboard, and then I remembered my own rule. Wait for confirmation. I resisted the urge. 10 minutes later, the market spiked in the opposite direction. That moment taught me a lesson I've carried for 20 years. Patience is a position too. Waiting is not passive, it's strategic. The psychology behind this is fascinating. Humans are wired to act. Our brains crave action because action gives us a sense of control, even when we shouldn't act at all. When you do nothing, you feel tension, uncertainty, and even guilt. You start asking yourself, am I missing an opportunity? But the market doesn't reward impatience, it rewards preparation, planning, and discipline. Let me tell you about Lisa, one of my students. She was new to trading and extremely active. She placed trade after trade, convinced that every candle held a secret opportunity. In the first month, she lost 30% of her small account. Frustrated, she called me and asked, "Why am I failing when I follow my strategy?" I asked her to show me her trades. What I saw was a pattern of impulsive entries, chasing setups that didn't meet her criteria. She was trading every candle and losing consistently. We worked on a new approach. I told her, Lisa, every time you feel the urge to trade impulsively, close your eyes, take a deep breath, and ask, does this setup meet my rules? If not, wait. At first it felt unnatural. She hated waiting. It was uncomfortable. But within a few weeks, her results transformed. By waiting for high-quality setups, she reduced losses, increased her winning percentage, and most importantly, built confidence in her discipline.
She realized that trading is not about constant action, it's about selective, strategic action. Patience in trading isn't just about waiting for setups, it's also about managing expectations. Many traders enter the market with unrealistic ideas. Every day must be profitable, every candle must move in their favor, and every opportunity must be seized. These expectations create pressure, forcing impulsive decisions. Learning to accept that the market moves in its own rhythm and that some days will be quiet is liberating. It allows you to trade with clarity, not emotion. Professional traders understand this deeply. They treat no trade as a valid strategy. They recognize that sitting on the sidelines is an active decision, not a sign of weakness. The market provides infinite opportunities, but only a fraction of them are worth taking. By filtering trades and waiting for setups that meet all criteria, they maximize the probability of success. This approach requires courage. The courage to resist action when every instinct screams, "Do something!" I once watched a veteran trader named Mark in action. He would spend hours watching the charts, sipping coffee, seemingly doing nothing. Then, after careful observation, he would take a trade with precision. It looked effortless. When I asked him why he waited so long, he said, "I don't want to trade noise. I only take positions when the setup gives me an edge." Every other candle is a lesson in patience. That mindset, that ability to wait, is what separates winners from losers in trading. Waiting also has a compounding effect on psychology. Each time you resist the urge to enter a low-probability trade, you strengthen discipline. You build trust in yourself and your strategy. This trust is invaluable because trading is as much about psychology as it is about technical analysis. When your mind trusts your plan, you act decisively when the right opportunity arises. When it doesn't, hesitation and fear creep in, sabotaging potential profits. Let's bring this into a real-world analogy. Imagine you're fishing. You could throw your line anywhere, hoping for a bite. You might catch something occasionally, but it's mostly luck. Or you could study the water, observe where the fish gather, and cast your line only when the conditions are right. The first approach is impulsive. The second is strategic. Trading is identical. Every candle isn't a guaranteed opportunity. The skill lies in recognizing when the probabilities align and acting decisively at the right moment. Another example. Think about cooking a complex meal. You have all the ingredients ready, but timing is crucial. If you add the spices too early, you ruin the flavor. If you act too quickly, you make mistakes. Patience allows the dish to come together perfectly. In trading, the dish is your account balance. Impulsive trades spoil it. Patient trades enhance it. Waiting also teaches emotional regulation. When you sit on the sidelines, you confront boredom, frustration, and fear, the same emotions that drive impulsive decisions. Learning to tolerate these feelings without acting on them is a superpower in trading. It builds resilience, reduces stress, and improves decision-making. I recall a trader named Ethan who struggled with impatience. Every time he waited for a setup, he fidgeted, clicked around, and almost always gave in to temptation. We started an exercise where he logged every time he resisted a trade. Over time, he saw patterns in his behavior. The time of day, market conditions, and even his mood influenced impulsive decisions. Awareness alone reduced the number of unnecessary trades. The lesson? Patience is trainable, just like any other skill. It's also crucial to understand that waiting doesn't mean passivity. While you wait, you observe, analyze, and prepare. You study market structure, track key levels, and review your plan. This active observation sharpens your edge. Traders who fail often confuse waiting with inactivity. They watch the market passively, get anxious, and eventually make impulsive trades. Waiting as a position is active, disciplined, and strategic. Risk management intersects beautifully with patience. By waiting for high-quality setups, you naturally reduce exposure to unnecessary risk. You avoid crowded trades, minimize stop-outs, and increase the likelihood of meaningful profits. This approach also allows you to protect your capital, your most valuable asset in trading. Without patience, even the best strategies fail because impulsive actions amplify losses. Let me share one final story. Years ago, I mentored a trader named Rachel. She had the technical skills but couldn't control her impulses. One day, she insisted on entering a trade even though her setup wasn't complete. I told her to wait. She argued, "I'll regret missing it." I smiled and said, "You'll regret it less if you wait and get the right one." Hours later, the market reversed sharply. Rachel avoided a loss simply by waiting. That single experience changed her perspective. She realized that in trading, restraint often yields better results than action. Ultimately, the market rewards patience. Each time you resist impulsive trades, you strengthen discipline, sharpen observation, and improve decision-making. The next candle will always come, and the one after that, by waiting for the right setup, you align yourself with probability, not emotion. You trade less, but when you do trade, you trade with confidence. Waiting is not weakness. It is a position. It is strategy. It is mastery over impulse, fear, and the noise of the market. The traders who succeed long-term are not those who act on every opportunity. They are those who wait, observe, and act only when the edge is clear. The next candle will always form, but the trader who masters patience will be ready when it matters most. And remember, every candle you skip is not a missed opportunity. It is a step toward discipline, consistency, and long-term success. By learning that waiting is a position too, you reclaim control over your mind, your decisions, and ultimately your trading results. The market moves as it will, but your calm, patient response will determine your edge.